The simple way to beat the market. Top 3 best index funds to invest in 2023. Have you ever wished there was an easy way to become rich with no prior experience? I am not referring to scamming or illegal ways, but to index funds. Index fund investing is easy, effective, and in most cases, actually ends up beating the profits of professional investors. Today, we're going on a journey through the 3 best index funds to invest in 2023, which have the potential to grow your wealth. Welcome to our channel that provides helpful videos on finance, investing, and earning more money in order to be independent and escape the financial system that has been binding us for ages. We do not provide financial advice, and anything that is said on this YouTube channel should not be seen as financial advice. These are biased opinions based on knowledge and personal experience. You should always understand that with investing there is always a risk, and do your own research before making any investments. A study published in 2020 showed over a 20-year period, nearly 80% of actively managed investment funds failed to beat the market. Simply put, experts who spend a full-time job trying to beat the market are unable to beat most investors that use the index fund strategy. So let's discuss what an index fund actually is, which ones are best, and how you can use them to get profits. People nowadays invest in crypto, stocks, or other methods that can help you multiply your investment very quickly. But they can lose money as fast as they can win it with these methods. However, the one thing that is consistent is index fund investment. No matter if the market is up or down every week, smart investors prioritize those investments, allowing them to grow wealth over the long term. So let's break down what index funds actually are. Think of them as Skittles. Now, as an investor, you could cherry-pick the ones that you like the most. This is called investing in individual stocks. However, these companies go bankrupt or crash value, you're in trouble. The great thing about index funds is with one simple purchase, you can own all the Skittles in the bowl without having to deal with all the hassle of creating your own hand-selected portfolio or having some expensive managers do it for you. This is because they're passively managed, which means they are extremely cost-effective. The truth is that if a stock or crypto can give you these kinds of returns, then it could also swing back the other way. The great thing about index funds is if one company from within the bull is having a bad time, like this one, boom, you've still got all the other companies holding it up. An index fund aims to track something called an index, which is a lot like a sports leaderboard. They can rank company size, location, business type, and even currencies. So because there are so many choices, let's pretend we're in a supermarket. And we'll walk you through our 3 favorite baskets of stocks to invest in. S&P 500 Index. Basket number 1 is, of course, the S&P 500 Index. This is the daddy of index funds, and you've probably heard people talking about it before. On average, the S&P 500 has returned investors 8 to 10% per year, which isn't anything crazy compared to the latest crazy like Shiba Inu or other shitcoins, but it is pretty consistent and much less volatile. That sounds great, but what's inside the basket? Well, the S&P 500 is a top 500 American company. Well, actually, it's 505 stocks to be exact. In order to be included in the S&P 500, a company must meet certain requirements, including in achieving a specific market cap, having the majority of its shares in public hands, and being a public company for at least a year. So if you buy one share of the S&P 500, you will actually own a small piece of Amazon, Tesla, Apple, PayPal, and so much more. The ultimate flex is telling your friends you own all of these companies. One of the benefits of the S&P 500 is that it's widely spread across many great companies in the USA. However, it's worth pointing out that the S&P 500 is a bit tech-heavy these days, with 5 big tech stocks dominating 23% of the entire fund. So, which one do I pick? Well, that depends on where you live in the world and what investing platform you're using. The best we found in the USA, the VFIAX Index Fund or the VOETF. The best in the UK would probably be the VUSI ETF. But there are tons of other ETFs that also track the S&P 500. One thing to look out for is that the dividends are reinvested into the fund. The only real difference between an index fund and an ETF, otherwise known as an exchange-traded fund, is that these can be purchased or sold at any time throughout the day, just like a stock, as long as the market is open, of course. That's why they're exchange-traded. It's in the name. Index funds can only be purchased in full once per day. So, for example, if the price of the fund is $500, you must pay $500. Whereas an ETF can also be purchased in fractional shares, which means you don't have to buy a full share and can instead invest whatever amount you like. This is great if you're just starting out, or you want a dollar cost average. Total Stock Market Index. Basket number 2 is a total stock market index. The total stock market index is, well, the definition of diversification. You can't really get any more skin in the game for a lower cost than this. So if you want to invest for a long period of time without having to check or even think about it, then this is most likely to fund you. Investing in everything means you can experience gains across the entire market. And unless a crazy crash happens, you should be okay. But even if it does crash, with time things bounce back. But downside to this index is that it depends on the entire market trending upwards. This means that there could be an individual stock that you really believe in that goes all the way to the moon, but you might not experience those gains because that one stock doesn't play much of a role within the index fund. If you're an active investor who likes to try to mess with options, this index fund is probably great to have as a safety net that you regularly invest into. Metaverse Index. Basket number 3, it's the Metaverse Index. A metaverse will be an improved digital environment where it is possible to move seamlessly between work, play, shopping, socializing, and creativity in one digital landscape. What form that landscape will take is a subject of debate. Firms such as Meta, Facebook, are investing heavily in an immersive experience, where users with wearable hardware discard reality for a purely virtual world, interacting via avatars, the basis for the oasis depicted in Ernest Cline's novel Ready Player One. This has just made us even more confident that the potential profit is insane, and therefore, it's not something that we can ignore. Because of this, investing more and more into companies that will be heavily involved in the metaverse. And I'm not just talking about Facebook Meta. Roundhill Investments is offering a Meta ETF. This makes things easier. It offers exposure to lots of companies that are set to benefit and take part in the metaverse all with one simple bite. But of course, the metaverse isn't here yet, and it's all just speculation at the moment. So that's definitely something to look out for and consider. This ETF also has quite a high expense ratio of 0.75%, which may not sound like a lot, but trust me, it's considerably more than a lot of the funds. We think the best way forward is to look at what stocks the Meta ETF holds, and then buy the ones you like individually. But if this sounds like too much hassle, then ETF is something to consider. So if you're sitting on the fence, then now is as good a time as ever to start your long-term investing journey. That was all for today's video. Thanks again, and make sure to subscribe if you want more tips on how to grow your wealth. We hope to see you in our next episodes. Goodbye, and take care.